The EU rushes to strike a deal with the US. But what's in the ECB's trade war chest? This is Macro Matters, and today we're talking trade. EU trade negotiators are planning to sit down with their US counterparts today in Washington as the bloc aims to reach a deal. Pressure is mounting before tariffs on nearly all of its exports to the US jump to 50% after the July 9th deadline. ECB President Lagarde warned in March that Brussels had no choice but to retaliate against the US. So is the central bank prepared for war? George Buckley is chief European economist at Nomura. So George, what's the economic toll of a trade war on the European economy? Is the ECB prepared for a worst case scenario?
Well, it could be sizable. 50% tariffs, which is what has been threatened, I think would be the end of trade for a lot of companies in Europe. I think when you think about countries like China, even with substantial tariffs on their goods into the US, they probably are still the cheapest supplying many goods into the US. That probably wouldn't be true for Europe. So even relatively small tariffs could do quite a bit of damage. We've already taken our growth forecast down to account for tariffs, but 50% would be a big it will be a game changer for a lot of firms. Now, we don't think we're going to get to that point. We think that there will be a deal. As Ms. von der Leyen has said, it might take some time to get a detailed deal into place and longer than the 9th of July. But as we've heard from Scott Bessent, they might be able to extend this discussion period until the early part of September.
Well, ECB officials have also warned of significant deflationary pressures with retaliation. Could we see much more interest rate cuts this year from the ECB?
So we think we will see 2 more interest rate cuts from the ECB this year, which is more than what the market's pricing. And part of that does reflect the fact that the currency appreciation, which has been around 15% since the start of the year. Don't forget, at the very start of this year, people were talking about whether the currency was going to go through parity. Now we have members of the ECB, including its vice president, talking about the possibility of it going above 120, that being a sort of magic point almost, that if it goes any further than that, there could be more serious repercussions. So it is having a very sizable effect on pulling down on import prices and potentially on CPI, on inflation going forwards. And that obviously means that if they do undershoot, and there's been a lot of talk about that at the ECB's annual gathering in Sintra in Portugal this week, where they've said that maybe we might need to do a few more rate cuts if it is the case that the currency continues to pull down more than we expect on inflation.
So if the euro does breach that 120 level, how can the central bank deal with this problem?
Well, it's going to find it very difficult to deal with it directly. We heard from Madame Lagarde, the president of the ECB, just this week saying, we do not target the currency. And that's very true. However, the currency plays a very large role in its forecast and the ECB's forecast for inflation and economic growth. And if it turns out that the currency is hurting exports, if it turns out it's pulling down on inflation below where the ECB would like it to settle, then one thing it will do is potentially cut interest rates more, not to influence the currency, but to offset it.
Well, Lagarde said this morning that the ECB is fully committed to its 2% inflation target, but should they move the goalposts?
No, I don't think they should. I think it's important for central banks to retain their credibility by keeping inflation targets static. The longer you have an inflation target, the more it becomes believable. Although that said, look before the pandemic in the euro area, we had interest rates at minus 0.5%. We had the central bank doing loads of quantitative easing, so buying government bonds with freshly minted money, and yet they still couldn't achieve in the 5-year run up to the pandemic inflation of more than 1% on average. That to me suggests it could be tricky to achieve the target, possibly from the downside rather than the upside. But I think it's important for credibility purposes to retain a target which most central banks actually now believe is the right target of around 2%.
Finally, George, the European Commission is reportedly seeking more joint debt in its EU budget plan for emergencies. Could this be used in a trade war?
I think more joint debt is probably one of the ways that the euro area and the European Union could go for, first of all, funding higher defence spending across Europe, because don't forget, a lot of countries unlike Germany, can simply not afford from a fiscal position to spend money on defence. And so it's important that they do this. In addition, I think it could be very beneficial to the euro itself, because if we have joint financing, then the EU and the euro area would look like a more exciting prospect for a lot of investors. So I think for those two reasons, joint funding is probably something we will ultimately see.
George Buckley, Chief European Economist at Nomura. Don't forget, you can watch more videos on Reuters.com.